Hello and welcome to the new episode of Death and Taxes, a weekly podcast by the private client team here at Burgess Salmon. My name is Edward Hayes and I'm a tax and trust lawyer in the private client team, and together with my tax and trust colleagues Guy Broadfield and Tim Williams, we will discuss a range of issues facing clients and professionals alike. Each episode, we're joined by a specialist lawyer or lawyers from around the firm to bring you our views on important topics for private clients. And in today's podcast, we're joined by Alex Lloyd. Alex is a director in the firm's corporate team, and he works in all areas of corporate finance. But for the purposes of this podcast, we're interested in his focus on high growth businesses, their founders and investors. And one example of that is Burgess Salmon's B-Scale project, spelled BSCALE, which supports such businesses right from inception to early funding rounds and hopefully all the way through to a successful exit. So Alex, we're really excited to talk to you about scaling your business and raising capital. And if you could just give us a quick run through, what does that mean from your perspective?
Cheers, Ed. Scaling a business, in my eyes, is going to be slightly skewed because I'm a corporate lawyer and I'm dealing with transactions all the time. So when someone comes to me, they're likely to be raising money, and they're likely to be raising money in the form of equity, specifically in my case. So we're looking at scaling through a fundraising, and that would be a Series Seed fundraising, a very early one, a Series A perhaps, Series B and Series C, stages of capital growth of the company. Of course, there's more to it than that, and there's all sorts of operational scaling that's going on in the background, and we would advise on that, but it wouldn't be me and the corporate team. So that's what I'm talking about. The other time that somebody might come to me in the context of scaling is if they're looking to do so through acquiring other businesses. So quite often we'll get a company that's a high growth company in its own right, and it's looking to acquire others. So we often are involved in M&A transactions in the context of scaling businesses through acquisition.
Great, makes a lot of sense. And have we got an example of something we've done recently that can kind of map out that pattern?
Yeah, I have. And this is what we want to do. We want to get involved really early with the business, act on their initial fundraisings. And in doing that, and that's a bit of an investment on our part, because at that point, cash resources are strapped, obviously. But we want to build a relationship there, and then we want to follow that company through. And a perfect example, through chance, is we've just done a big exit for a client of ours that's been a long-standing client that we've been with from the start. So Embark Group, it's a digital retirement solutions business, which is, think of it, it's a financial services business, tech-enabled, think of it like that. So we acted for them where they took some money from some high net worths in the first place. There was a CEO and some high net worths from the city. They went through multiple acquisitions after that. They were buying up lots of other companies and building their assets under management to get them to a point where they could exit. And they were initially looking for an IPO. And through that journey, there were those acquisitions, there were joint ventures, and then they started raising capital from significant institutions. So their cap table, their list of shareholders, changed from a list of high net worth individuals to BlackRock, Marion Chrysalis, Franklin Templeton, and some strategic investors as well in the form of their major IT partner, which was a company called FNZ. So they went through that, raised some serious money, and then they were looking to exit. Could have been an IPO. It ended up being a sale to Lloyd's Banking Group, and they exited. It was £390 million sale. So that is the journey that we want for ourselves and for the clients. And that's exactly the sort of example that I'd give.
Alex, in that example, you've mentioned the various different types of investor, but at the outset, and for the purposes of this pod, it's probably just worth exploring that a little bit in more detail to sort of set out who the parties are and what different types of funding that there is.
Yeah, sure. So let's start at the bottom, I suppose. So you've got grant funding is the first one, and we wouldn't necessarily be involved too heavily in that, but there's lots of grant funding available from Innovate UK and other government sources. So there's your first source of capital. Next, you might look at friends and family rounds. So lots of startups get their very early capital from their friends and their family. And there are pitfalls in doing that, of course, but that's a great source of money early on. If you take a step up from that, I suppose you're looking at high net worths and angel networks. And that source of funds in the UK is centered heavily around tax advantage schemes. So those people are looking for Enterprise Investment Scheme, EIS, or Seed Enterprise Investment Scheme, SEIS, tax reliefs. And so the form of those rounds is often shaped by the tax advantages the investors are looking for. And they'll want the companies to be EIS compliant in order for them to get those tax advantages. So there's your next bucket, angels and high net worths. And then you're looking at venture capital money. So these are funds, specifically designed to invest in early stage, high growth businesses. It's a high risk form of investing for a fund, I suppose. And 2021 would be a record breaking year for venture capital. So there's plenty of money out there from these venture capital funds. Beyond that, there are other investors, of course. If you can think about strategic investors, and more of our sort of established corporate clients are setting up venturing arms. So you'll have a big corporate looking to make a strategic investment in a smaller company, either with an eye to buying it eventually, or to supporting the broader ecosystem that it works in, or to get a feel for how things are moving and changing in the industry. So it's a way of them innovating through investment. So those are the.
You mentioned those investors who are really interested in the tax efficient means of investing. And is it fair to say that's one of the key reasons, frankly, why making sure your house is in order early on as a startup is so key?
Yeah, those guys, and I mean, when we're talking about angel investments, I don't know the exact number, but it'll be over 80% looking for EIS or SCIS treatment. So that company needs to make sure that it's going to comply with the regulations and be EIS compliant. So yes, absolutely crucial that they do that. And there'll be provisions in the documents as well, which say you will maintain that status, and there'll be consequences if you don't.
And have you seen kind of examples of businesses who they suddenly realize they need to turn to angel investors, for example, and actually their articles don't quite work, or they've got the wrong kind of shares in issue and that kind of thing? If you've got examples, kind of things where that's gone wrong in the past?
Yeah, you quite often see, in terms of the classes of shares, so you quite often see, because in order to get that EIS relief, the investor's capital has to be on risk. So you can't have all sorts of protections on your equity stake. You have to be at risk of losing it. So you can't have your really funky anti-dilution protections, or you can't have preferential shares that are going to give you an element of protection, which means you're not really at risk. And quite often you see mistakes being made by both the investors and the investee companies, with the investors saying, I want this, that, and the other sort of protection, and the investee company caving in, and then them later realizing, oh dear, that means that we've now created a class of shares which doesn't fit within the tax advantage scheme. So that's one error. Also, the rules, the EIS and SCIS rules, are fairly complicated, and you have to be a trading business in order to qualify. We don't want to get into the detail of that here, but it is absolutely worthwhile just making 100% sure that your company is going to qualify, and that the investor's not asking for some share right that's going to push it outside of the regime. And also there are also limits on the amount of cash you can raise. So it's 5 million a year for EIS, up to a maximum of 12 million. And there are slightly different rules if you're an R&D heavy, if you're a research and development heavy company, or knowledge intensive is the phrase used. So there's all sorts of pitfalls.
Yeah, all gets across the need for someone who understands this. And Guy and I see this from the other side, because we're often acting for individual investors and so forth, and we're very aware of how important those tax breaks are, and the difference it makes when you're looking at a potential kind of private investment. And sometimes they'll have started out life with whichever, say, accountancy or law firm they could afford, which might be a kind of small little local outfit and so forth. And the problem there, that I presume you've seen from your end, Alex, as well, is you might end up with the wrong kind of starting position. And then when you're trying to scale up and grow, it's actually hard to do that, because you've inhibited yourself in the way you've begun life. Is that fair from your point of view?
That's fair. And I mean, there's always going to be a trade-off, right, between, you've got financial resources are constrained, time's restrained. You want to build the business itself. You don't want to be spending time on your legals, and I understand that. And that's why we created that our B-scale product, really, was to give some basic operational documents and some really, really early fundraising documents away for free. The idea being, at least you've got there a platform from which to build, but recognize that these companies are not going to be absolutely perfect in their legal work at this point. They won't have the money to spend thousands and thousands on every single contract, but you do have to get the basics right, and you do come across mistakes quite a lot. And the obvious stuff is, you've got a cap table, you've got a list of shareholders that's confused. You've offered someone some equity without documenting it properly. You've got a convertible loan note that doesn't actually work because you've got it off the shelf, but then tried to make it bespoke yourself. Or there's you've given away shares to people on a promise without actually writing it down. And all these things sound a bit silly, but they're absolutely half true. or you get some options. You offer an employee some options in the company, but you haven't documented the option scheme properly. It doesn't quite qualify for the tax advantage that you think it should. So that's the cap table. And think about IP. You've got a critical piece of IP. It's not actually owned by the business. Investor comes in to look at it. So, well, this IP isn't invested in the company that I'm investing in. So you've got to then sort that out. You've got a business critical contract, and the contract's poorly documented, and you've sort of that contract is underpinning the valuation of the business. And then the sort of one which everyone's going to get wrong a little bit is, your data protection policy is not quite right. You haven't registered with the Information Commissioner's Office. You haven't sorted out your auto enrollment quite right in your pensions. Your health and safety policy. All the sort of compliance elements. And they're not going to be perfect, but it's sort of a bit of a red flag for investors if they're completely askew or off the mark. So I'm afraid at some point when you're looking to take some money, you've got to get your house in order. It's on that basic level. And you see mistakes all the time.
And inevitably, when there's mistakes, you might find that that's where disputes arise. I've seen it before where business owners given some shares to a sibling in the knowledge that, and the understanding that the sibling would make further equity investments or indeed possibly give those shares back to his brother at some point in time. That doesn't happen. The business has grown significantly. The shares that they've given away have significant value, and that's not been documented properly, and that's where disputes can arise, and ultimately it's value destructive, Alex.
Yeah, absolutely. All of this stuff, that's the whole point, isn't it? I guess from all of this, you're limiting the amount of cash you can raise, and also the valuation of the company, because if there are mistakes, they're either going to need to be remedied, or you're going to put off potential investors and drive down your own valuation. So all of that is true. Having a nice clean set of legal documents you can present to an investor along when they're doing their due diligence makes the whole process easier. I'm not saying these things can't be fixed, by the way. Cool.
A great job of setting out the minefield that is starting out.
I've made it sound too bad, haven't I, Ed? I didn't mean to.
Well, shall we walk through in a really basic way how our B scale kind of offering is there to guide you through that and try and manage that tension that you can see between being a really small business, doesn't have the resources at the outset, and doesn't have the time, frankly, to spend it on kind of legals, to suddenly finding yourself in a position where you kind of need your legals in order, and how we can kind of help a bit in that place and be there for the bigger events later down the line.
Yeah, sure, I can. Well, first of all, the point of it really is to invest a bit of time, our time, and therefore our money, I suppose, in the really early stage companies. And it's all about recognizing that problem that we've just talked about: no cash, but need to get some basic legal documentation in place. So the system is totally free for a start. That's the main point, and there's no strings attached to it. You just give an email address and you can download a set of documents. At the moment, those documents are, you've got a shareholders agreement and articles for a really early stage fundraising. So the idea being you're raising a small amount of money, the legal fees would be disproportionate, but you can there have a solid set of documents that you can use as a starting point for that raise. Those are the main ones. And then you've got a set of operational documents for your day-to-day, just to try and give you a base level of documentation that's workable, usable, and be recognizable to investors down the line. And there's an employment contract in there. There's a confidentiality agreement. There are website terms. There are privacy policy. So this gives you just a basic set of documents that you can use free of charge. That's the idea.
And we're building a foundation, aren't we? That's my understanding. We're giving you that foundation. It's not perfect necessarily, but it will give you all the key stuff and give you a foundation that by the time you need to be, as a client, thinking about these things in more detail, you're hopefully then tweaking around the edges and finessing rather than ripping up and starting again because everything's just a complete mess. Is that a fair kind of summary of what we're trying to achieve with that?
That's the point. And it gets you through to, because there'll come a point where you're raising enough money that fundraising means that it's now proportionate to seek proper legal advice, and then this has bridged the gap and got you to that point. That's the hope. And then once you're at that point, you've got there's still an issue with funding and legal costs, because if you're raising a small amount of capital, spending a huge amount on a top law firm is a very difficult thing to swallow, and also the investor won't be expecting the company to swallow a huge level of legal fees. So you've got a choice then. You can go to bigger significant law firms and pay the fees, or you can go to a smaller high street firm and pay a smaller fee but perhaps don't quite get the expertise, and importantly don't get because you want to be starting a relationship. I think there's value in starting a relationship with a firm that can then support you through your regulatory work, your commercial contracts, that has some sector knowledge. If you're a clean tech business, great to know a law firm that knows all this clean tech investors, say, in the landscape well. So you want to be building that relationship. So there's a gap, or we feel there's a bit of a gap, where bigger law firms like us, need to invest in those early stage rounds. So you've used up the B scale piece, you're now raising some proper money, and we'll come in with a really low fee for that initial fundraising. The idea being that we're investing time, and we're investing time to build a long-term relationship and to end up in that embark situation that we just talked about.
So Alex, if you've grown the business out of that initial stage and in the fortunate position to sort of look to take on external investments, I guess the question is, who are you going to speak to, and who do you want as your investors in your company?
Yeah, thanks, Guy. Well, it depends, I suppose, on the nature of the business and what you're looking for out of the fundraising. But I suppose let's talk about it in broad terms, and about the mistakes that people make. You seem to be harking on about the negative here, but I think it's instructive to point out the mistakes so people get it right when they do it. The first obvious error that you see, or problem that you see, is that founders have given away a hell of a lot of equity in the early days of the business, too much equity. And then you get a VC comes in, and we've seen this multiple times. The VC comes in, they look at the cap table, and they're like, well, hang on, the two or three people that are going to drive the business and deliver the returns for me, they haven't got a big enough stake in this company anymore to be properly incentivized. And you've got a whole bunch of other people who are going to make money out of this who aren't driving the business. So there's an obvious early fault, which is obviously painful for the founders because they've just given away too much, but also, strangely enough, painful for the investors, especially if they're professional investors. They'll see that as a gap. So that's point one. Try to avoid over diluting yourself. Clearly, it's dependent on the situation and the need at the time, but that's one. Second is you often get these cap tables that are really confused. There's a huge number of people on there with really small investment amounts, and that can become unwieldy because you've got a big shareholder base you've got to communicate with and deal with, get consents from, and when it comes to exit, you've got all these people with all these differing views in your shareholder base. So unwieldy cap tables can be a problem as well. Then you've got to think about, what are the investors going to bring to the table? So if you think about a venture capital fund, lots of them, well, first of all, it's great to have a good name on your cap table in one sense. If there's been a legitimate and a well-known VC has invested, it gives you some credibility. So that's one thing to think about. Secondly, a lot of them are now offering more than just cash. So they'll offer you access to support, and they'll help you to build your business as well. So there'll be soft benefits alongside hard money with venture capital funds quite often. Then you've got strategic investors. So is there a corporate out there that could add a lot to the business by investing? Can they do it through access to their network? Are there contracts to be made with that corporate? So there's a strategic element if you're looking at corporate venturing. Then you've got your angels. Some of those angels will bring with them a hell of a lot of knowledge as well. If you've got someone who's experienced in the sector coming on board as an angel investor, will they sit on the board? Will they give you share some of their expertise with you? So there's that. What can the investors bring? It's an obvious bit. And the next one, which we see quite a bit, is varying expectations between UK investors, say, and US investors or foreign investors of any type. Because remember, going back to what we were saying earlier about tax advantage schemes being very important in early stage fundraisings in the UK. So, as I also said before, if you're looking for EIS tax reliefs, you've got to take ordinary shares effectively, and there's a limit to the number of contractual protections you can have. So if you're raising generally from those investors, they're going to get a sort of plain vanilla situation. They're going to be on risk. And then you're looking at taking money from we got it at the moment actually with one who was looking to raise money from a Russian investor, which has caused all sorts of problems now, given the situation in Ukraine for a start. But even before that Russian investor was expecting all sorts of anti-dilution protections and preferential share rights. And it was putting them on a very different plane to the UK angels who were looking for EIS treatment. So you can imagine you can create tension because of the different expectations of the different investors, maybe by jurisdiction or just by type of investor or just by their attitude. And then I suppose it's worth saying as well, there's a geopolitical element to it, isn't there? There's a reputational element to it. That Russian investor 6 months ago looked like a great addition to the cap table. Now looks like worrisome addition to the cap table, and other shareholders might express concerns about it.
And
so
it's interesting, isn't it? The way I kind of think about it is the way you divide up the pie almost has a surprising impact on the value of the pie, because you can do the best job in the world of growing your business and actually having strong fundamentals and kind of the economics of what you're doing, and it's such a shame if the way you've just shareholders is undermining all that.
Yeah, and you do see that, Ed, and you see conflict as between them. They've very different priorities. Say, come to an exit, you've got a company's been going quite a while at this point. You've got some high net worths who came in really early at a really low valuation. They were already looking to turn, they're already going to make a big return on an exit. You've then got somebody who's come in years down the line. They come in at a much different valuation. An exit for them at this point doesn't look so attractive. The money hasn't been in for very long. They had in mind that there would be a longer hold, looking for a bigger exit or an IPO later down the line. And suddenly you've got two sets of shareholders with very competing interests. These want to get out because they've already made a good return. These just came in, so they're not pushing for an exit. And you're going to have then be going back to your shareholders agreement and working out who does and doesn't control the ability to sell the company, for example, or to float the company. So yeah, the shareholder base and having a consistent shareholder base that's happy is crucial.
And another area of some crossover, isn't there, between you and us in terms of the corporate side and the private client, is the death of a shareholder, and how if you haven't really planned that out, that can cause all sorts of mayhem, both for the company and for the individual's family.
Yeah, there's loads of crossovers actually, which we should probably get into a little bit, shouldn't we? So yeah, you do often see clients come to us and they'll say, well, I'm in business with my partner. What happens if he or she dies? I don't particularly want to be in business then with whoever's going to inherit the shares under their will, be it their wife or their kids. And there are insurance solutions to deal with that. You can end up with a shareholder protection style insurance arrangements whereby the policy pays out and the company can buy the shares back, or it pays out to the other shareholder, giving them the cash to acquire the shares from the estate. And my role in that would be to draft some put and call options, so the ability for one or the other to force the sale or the acquisition of those shares. There's that piece. And I suppose the other crossover, Ed, is where quite often founders and investors want the ability to transfer their shares to family trusts or to spouses or as part of their estate and tax planning generally. So there's often a bit of a trade-off there as between that flexibility versus the investors or the other founders don't necessarily want shares ending up left, right, and centre. They want some level of control over that. So there's a fair bit of crossover as it comes to shares as assets in somebody's estate or somebody's will.
Absolutely.
So, Alex, from what you're saying, it's clearly important that the founders consider, what should happen on the death of one of the founders and how that's dealt with, as between them in the articles of the company, etc. In terms of raising finance and fundraising, that would be one part of on the list of so-called founder risks that will need to be dealt with as part of the agreement going forward. What are the other types of founder risks that you see, and what are the other sort of key terms that need to be dealt with as part of any fundraising?
Yeah, so key risks for founders personally. So when you raise this money, this funny thing is it becomes very emotive, right? Because you're raising money. This is your baby, this company, and suddenly someone's coming in and trying to impose some terms onto you. And the sort of key one, the ones that go to the heart of the founder, I suppose, are, if you think about it from the investor's point of view, they're coming in and they're saying to you, we're backing you as individuals to deliver a business plan that ultimately is going to deliver some returns for us as investors. We can't have you leave the business because that's just destroying the value in our investment. So you end up with these good and bad leaver provisions, meaning there's usually a compulsory transfer of your shares if you leave the business, and the manner of your leaving determines the amount of money you get as part of that compulsory transfer. So that's founder risk one. Get those right. Founder risk two, think about non-compete, restrictive covenants and non-competes, non-solicitation of employees and customers. Really, it's all about your ability as a founder to work once you've left this business. So if something goes wrong and you leave the business for whatever reason, you don't want to be trapped, locked out of the market for too long. So you've got to make sure those restrictive covenants aren't too restrictive and don't last for too long. You quite often see them drafted in such a way that they potentially stop people from earning a living. Then you've got the obvious one, which is you're going to give some warranties to these people who are investing. They're saying to you, we're putting our money in, we want you to make some contractual promises about this business. and that'll give rise to personal liability for the founders. Key concept to take away there is the investors really don't want to be suing you, because if they sue you as the founder, the very person that's going to deliver value, they're destroying their own. It's value destructive for the investor, so it's a sort of last resort option for them, which gives you a good reason to say, well, in that case, the limit of my liability should be enough to be painful, but not to ruin me, because that's not the point of this. Isn't about you recovering. It's about you focusing my mind, and you set the level accordingly. And then you've got economic rights in general. So if you've got an investor with a class of shares that ranks so far above your class of shares that on an exit or on a return of capital of any kind, you're so far down the waterfall you don't get the money out. That's another key. So those are sort of the crux of the ones that really go to the heart of the founders. Probably rabbiting on a bit here, but very quickly, the other issue is governance and control of the business. So you've been running it your own way, you've been doing it successfully, you've got a business plan, they're backing that business plan. The other risk is that they then come in, impose enough controls on you that you're suddenly hamstrung into how you can move the business. And if it's a young business, you may need to be able to pivot and to change direction and to move in whichever way the market tells you to move. So there's those operational freedoms, veto rights, board control, etc.
Great, Alex. That all makes a lot of sense. And is it fair to say those early rounds of fundraising, a key part of that is just setting the bar in the right place? So you know where your business is going, and people who follow on afterwards have a precedent that they're happy with?
Yeah, exactly, Ed. I mean, if you think about it, an investor coming in later, they're hardly going to reverse the gains that previous investors have made in the documents and lighten them in your favor. So exactly, you start off with a solid foundation, and that's what B-Scale is about. It's getting that foundation for that really, really early stage. Then you come to your next round. We'll help. We'll help at a reduced rate to recognize the tension between the need for advice and the finances that are available. And then you build from there. So, and the way that I'd like to see it is a really long-term relationship between the company and the law firm. The same law firm that advised on that investment round is then advising on the commercial contracts as you go through, is then a great place to advise you on the next fundraising, and then eventually, your Series C, and then your exit. And if you've got that continuity, I think there is real value in that. But it requires something from the law firm. It requires the law firm to acknowledge that they've got to invest some time in the early stages. I'm not saying you couldn't have multiple law firms acting for you, but there's got to be a benefit in having that continuity, and that's what we're looking to achieve.
Great stuff. And then hopefully you get to the end, your business is worth whatever your successful exit will allow you to make on it. And it happens that on season 1 of Death and Taxes, we had an episode covering exactly that eventuality. So please do feel free to look up Selling Your Business, How to Make a Successful Exit. And that would, in an ideal world, that completes kind of, I suppose, the journey with your team, Alex. But then Guy and I often step in with clients at that point and help them, with that value they've created and the new liquidity for the family, advising them what to do with that, what kind of estate planning they can use, whether there are new business ventures they want to kind of put that back into, and how to do that. So I suppose another point to make just more generally is Burgess Salmon's well set up with the corporate expertise and the private client expertise to cover all bases on that and actually be able to help families with that, the journey both with the business and kind of their personal journey alongside it. Well, Alex, it's been great talking to you. Thank you very much for all your help today. I think very insightful and something that all our listeners will appreciate enormously. Anything else you want to add, or is that enough for today?
No, that's great. It's been a pleasure, chaps. Thanks very much, Ed and Guy. It's been good to be on.
Great to have you.
Thanks again for listening to Death and Taxes, a private client podcast from Burgess Salmon. You can find out more about Burgess Salmon and our team at burgess-salmon.com or on our LinkedIn page. This is the final episode of Season 2 of Death and Taxes, and we hope you've enjoyed listening to the private wealth content from Burgess Salmon. Keep an eye out for details of an upcoming special interview featuring our long-standing Burgess Salmon client. And in the meantime, don't forget to subscribe to all episodes from Season 1 and 2.